We're going to jump right into what you need to know. There's not a lot to review because this is a lot of very new content. The only thing I considered putting there was net exports, but we're going to get a lot of that within the context of the new stuff. So we're going to jump right into what you need to know here as it pertains to the balance of payments. And we're going to start just with some definitional stuff. There's a little bit, it's almost like accounting, like I said. We are accounting for transactions between nations, between economies. And there's some basic terminology we need to know before we get into the actual balance of payments. And the first is, what are debits and what are credits? What does that mean? What we're doing is we're tracing financial capital. Remember what financial capital is. It's basically money. Financial capital that is flowing between between economies, sorry. And we want to know, is the financial capital flowing into the economy? Is it flowing out of the economy? Debit and credit is how we account for that. So let's say we have trade between the US and the UK. Money flowing from the UK into the US would be called a credit to the United States balance of payments. I'm looking at this from a US perspective. We can look at it from the perspective of any country in the world, obviously, and the same rules are going to apply. Because I'm speaking here in Atlanta, Georgia, I'm in the US, and I know many of you are as well. We're going to take a US perspective, but please understand any perspective would work here. So looking at it from the US perspective, that money flowing into the US, we call that a credit. That's money coming into the US. Why would that happen? Well, it could be because the British people are buying goods from the US. It could be because they're well, it could be for a lot of reasons. They're lending money to people in the US. Could be a lot of different reasons, but money is flowing into the US from the UK. We call that a credit. If money is flowing out of the US into the UK, we call that a debit. Money is leaving. Think of your debit card. Money is leaving a bank account when you use a debit card. So credit, money coming in, debit, money going out. Very, very basic, very definitional, I know, but it's very important, and it's easy to confuse the two. We're going to have to use those terms when we apply things into these transactions in the current account and the capital and financial account of the balance of payments. So let's get into those accounts. What actually makes up the balance of payments accounts? Define it first. The balance of payments is an accounting system that records a country's international transactions for a particular period of time. Consists of the current account, which we'll abbreviate with a CA, and the capital and financial account, which we abbreviate with a CFA. Let's talk about the current account first. The current account, first of all, you're going to hear more about that one. The current account balance is going to be in the news more frequently. Changes in current account balance would be in the news more frequently. So a lot of people are probably more familiar with the current account. Here's why. This is where we record net exports. And again, a reminder of what net exports are. That's exports minus imports. Ultimately, we're talking about the purchase and sale of goods and services between countries. That's the bulk of the current account, is the balance of trade is represented by net exports, but also net income from abroad and net unilateral transfers. Now, those are technical terms for that. What exactly does that mean? Well, let's talk about that in the context of a few examples of current account transactions. As I just said, net exports, that's simply the purchase or sale of goods between countries. Products that are produced, again, from a US perspective, products that are produced domestically within the United States, but purchased, say, by someone in Canada, well, those are exported goods. And if there are goods that are produced in Canada that are purchased by people in America, from the American perspective, those are imported goods. So net exports would be taking those exports and subtracting from them imports. All of those transactions are going to go in the current account. Earning income from assets owned in another country. That's an example. That's a kind of a specific example, but earning income from assets owned in another country. So let's say you own a stock, or you own a bond, or anything else. You own real estate, and that's paying you interest or paying you some form of income. That would be recorded on the current account, or the opposite, obviously. If someone in another country, someone in Canada, owns property in the US and they're earning income off that property, that income is going to be reported on the current account. And then finally, sending or receiving income from another country. That's an example of a transfer. Remember transfer payments in general. We've talked about this before. I'm sure your teachers have talked about transfer payments. When you think about government transfer payments, even domestically, it's a payment for something without a good or a service being exchanged for it. Well, transfer payments happen internationally as well. And when they do, they are going to be recorded on the current account. A few more notes about the current account itself. We can look at the current account individually as its own entity. And the current account's not always balanced. If debits and credits are even between them on the current account, then it's balanced. We would say there is a balance to the current account. But oftentimes there's either a surplus or a deficit to the current account itself. So the current account can run at a surplus, more money coming in, or it can run at a deficit, more money leaving. Within the current account, we need to be aware that the balance of trade may also run at a surplus or deficit. This is something we hear in the news. This is something we hear in politics. What is the balance between exports and imports? Of course, if the two are equal, then it is balanced trade, but that's, again, unlikely in most countries in the world. If and when exports are greater than imports, if more goods are going out, therefore money coming in, you have a surplus in the balance of trade. And more than likely, the balance of trade is going to dictate the current account balance. It's not guaranteed, but more than likely because it's such a large proportion of the current account balance. If imports exceed exports, then you have a balance of trade deficit. So when you see in the news talk about the United States trade deficit, it means that in the United States, we're importing more goods than we export. And we're going to come back to that in just a moment, talk about the implications of that on the overall balance of payments, because it does have implications, and we want to discuss that. But before doing that, we need to look at the other side. We need to look at the capital and financial account, CFA. So what's recorded on the capital and financial accounts? Well, financial capital transfers, purchase and sales of assets between countries. So that sounds kind of technical, but what it's really saying is it's transactions which are going to create and include some form of liability. To me, it's a little easier to look at examples. What do we mean by this? So examples of that, a lot of what gets recorded on the capital and financial account would be the purchase or sale of financial assets, varying types of financial assets, stocks, bonds, other interest-bearing assets, which you can go back to Unit 4 and rethink what are those other interest-bearing assets. If those are being purchased, let's say if we're here in the US and they're being purchased from other countries around the world, that transaction is recorded on the capital and financial account. So again, whether it's a stock, it's a bond, any other interest-bearing asset, those are recorded here, capital and financial account. Foreign exchange market transactions. We haven't gotten there yet. We're going to go there very, very soon. In the next few days, we'll talk about the foreign exchange market. If you're in the United States and for whatever reasons we'll discuss later, you decide you need to purchase euros or pounds or yen or ruble or whatever, that transaction would go on the capital and financial account. And of course, the opposite is also true. Anyone outside the US purchasing dollars on the foreign exchange market, that also goes on their capital and financial account. Purchase and sale of real estate. I point this one out because I think it's a very good example to help with something. It's easy to confuse or know where to draw the line between net exports and the purchase of assets in some cases, physical assets in particular. And I had a colleague one time tell me, think of it this way, and this is more or less going to be true for you. If you go to another country and you buy something and you bring it home with you, it's an imported good. But if you buy something and you can't bring it home, like real estate, it's going to go here on the capital and financial account. I can't bring that home with me. A company builds a factory in another country. They can't bring it home with them. The factory stays there. That's going to go on the capital and financial account. That transaction will, for both countries, obviously. So that's why I put that example up here. Foreign direct investment is a version of that. You know the word investment spending, and this is, again, business spending ultimately. The example I just gave, company builds a factory in another country, that's foreign direct investment. It's going to go on the capital and financial account. I'm here in Georgia. If you go down to South Georgia, you go down 85 and you're about to hit Alabama and Troup County, there's a big Kia factory right there in LaGrange, Georgia. When that was built, that was a big deal. It was big news. That was foreign direct investment. You had a company from Korea coming in and they built a factory in the United States, and you had financial capital flowing into the United States as a result. So that would be recorded as a credit to the United States capital and financial account. Of course, that means it was a debit for Korea because the money was leaving. That's an example of a foreign direct investment that would be recorded on the capital and financial account. As a reminder, as we just said, for the current account, it's also true for the capital and financial account. It's not always balanced. You can have a surplus, you can have a deficit. If there's a surplus, there's financial capital inflow. If there's a deficit, there's financial capital outflow, sometimes called capital flight. Those changes in the capital and financial account balance are going to affect the loanable funds market. They're going to affect the supply of loanable funds. Make that connection. Go ahead and make that connection. I'm not going to get into it today because it's going to come up down the road in a later lesson, but that's an important connection you need to make, that those changes in capital flows are going to affect the supply of loanable funds. You probably already know that. Your teacher probably told you that the first day you did the loanable funds market. So think of this as more of a reminder because it's something we're going to use next week. So again, connect the capital account, the capital financial account, to the supply of loanable funds, and that capital flow is a shifter of the supply of loanable funds. All right, so those are the parts. You put those two together and you get the balance of payments accounts. Remember this, I already said it, any transaction that causes money to flow in is a credit, any money that causes money to flow out is a debit. So an important part to this, the sum of all credits has got to match the sum of all debits for the overall balance of payments. Not necessarily within the current account or the capital financial account, but for the overall balance of payments. So for example, if there's an increase in the current account balance, say there's a surplus, then there's got to be a decrease in the capital financial account balance, or vice versa. They both work out that way. That's why it's the balance of payments. These two sides have to balance each other out. That's how it works. And in the end, this identity is going to be true. Write that down and know that. The current account plus the capital financial account must equal zero, meaning the balance of the two must equal zero. So if there's a surplus in the current account, there's got to be a deficit in the capital financial. If there's a deficit in current account, there's got to be a surplus in the capital financial, so that when you add them up, they're going to equal zero. We can take that as fact, but again, you're an AP macro. Let's take the next step and understand why. Why is that? Why must there be these offsetting effects? Well, let's go there. All right, so a little visual here that I had a little trouble wrapping my head around a little bit, but I think it's helpful. Let's assume that this big rectangular cube thing here, it represents our balance of payments. And we have, let's just say the capital financial account is up here in blue and the current account is down here in green. Let's say they're balanced as they always are, but both of these are individually balanced. So right in there, that white line represents essentially zero. There's no surplus or deficit on either one. They are balanced out. So that's where we start here in this example. Now let's assume that in whatever hypothetical country we are in, there's a trade deficit, and that trade deficit leads to a current account deficit, which means the balance is a negative balance. And I'm going to show that visually in just a moment, but I want to walk through what happens to cause the changes that we're going to see. Why must that trade deficit, why must that current account deficit be accompanied by a capital financial account surplus? Well, because we said so, obviously, and the short answer is because of this equation. But let's get into what actually is going on. If there's a trade deficit, we know that means that imports are greater than exports, that a nation is bringing in more goods and then it is selling to other nations. And ultimately, because of the way we calculate GDP, C plus I plus G plus NX, I'm looking at the expenditures approach, of course. What this is really saying is that the citizens of a nation are purchasing more than they're producing. They're purchasing more than national income. And to do this, we have to pay for it somehow. Money has to be borrowed from abroad. And that borrowed money is a separate transaction, which is going to be on the capital and financial account. In other words, a liability is being created with that borrowed money. So the debit to the current account, that trade deficit, money leaving to purchase all those imported goods, is going to be offset by a credit to the capital and financial account. And remember, that white line was zero. The capital financial account is going to move past zero into a surplus, where the green, the current account, is going to move into deficit as a result. They still balance each other out, but you have now a surplus on the capital financial account and a deficit on the current account. That's the reason why. And again, it all comes down to this equation. It comes down to this equation, and it comes down to the term balance of payments.